it's 7 o'clock, so we might actually get started. Thank you, everybody, for coming along and logging into this webinar. I'm just going to go through some brief introductory statements and then we'll be moving straight on with our presentation. So before we get really started, I wanted to acknowledge our project partners, particularly Arrive Wealth Management Victoria, who are helping to present this webinar free of charge as a pro bono service to us tonight. So we really do appreciate the staff from Arrive Wealth Management coming along. Also, thank you very much to Breast Cancer Network Australia, Ovarian Cancer Australia, BRECAN and Think Pink. And I guess the involvement of several organisations has meant that we've been able to promote this widely and offer it to a greater number of women across Australia and women and their families. So thank you so much to these organisations for their support. I just have some housekeeping for you. Just to let you know that any microphones that you've got on your computer, or if you're listening in via teleconference, all of those lines are automatically muted. So although hopefully you can hear us, we can't hear you, and it just means we don't get the background cups of tea and probably cleaning up the dinner dishes if it's anything like my house at home. So yeah, as I said, you can hear us, I hope, but we can't hear you. But if you would like to communicate with us, either to ask a question or make a comment to another person in the webinar, you're welcome to do that. And the way you do that is to use the chat box on the bottom right-hand side of the screen. You can see there's a little section there for you to type your comment in, and a little button on the side with a little curly arrow that you can use to put the message up to everybody else. And you can actually send a message to everyone if you like, or you can actually just send a message to particular people in the webinar. So you're welcome to use that. If you're having trouble hearing, the numbers that might be of help to you are on the screen. So if your computer internet connection's not that fabulous, sometimes the audio can be a bit patchy. If that's a problem for you, you're welcome to join us by teleconference, and the way you do that is just to call the 1-800 number on the screen there, and then there's a passcode followed by the hash key that you put in. If there's any other problems that you're having, you can contact us on the number below on the screen. That's a Melbourne number. Just to let you know, the general format of this evening will be that we will be hearing from our guest expert, Joan Berkery-Coleman, who will be going through some really comprehensive information about financial planning when cancer's on the scene. We've also got in the background our other two experts, so I'll give those an introduction in a second. But just before we do, at the end of this webinar, you'll be invited to participate in an evaluation, and I would just really encourage you to stick around for the just 5 minutes or so after the webinar that will take to fill out. This is the second in a series of two pilot webinars that we're just trialling this year, and we're very keen to get people's feedback so that we can improve these events for the future. So we'd really appreciate that. So without further ado, I'd like to introduce our guest expert, Joan Berkery-Coleman. Joan has a dazzling array of qualifications, and she's been in the financial services industry for over 30 years, worked at lots of different organisations. She works with clients to ensure their long-term financial goals support their life plans. So she's committed to a deep ongoing relationship with clients to educate, encourage and assist them with the implementation of the strategies developed to achieve short, medium and long-term goals. Her focus is on the protection and creation of wealth through the provision of strategic advice, investment management and the regular review of financial plans. So I'm going to turn Joan's webcam on, and I'm going to actually come off the screen myself because you don't need to see me, and we will move on with the presentation. Welcome, Joan.
Thank you, Kate, and good evening, everyone. Welcome to the second in the current series of webinars brought to you by the Cancer Council. This is my first too, so it's a little bit exciting for all of us. In this evening's session, we're addressing some of the immediate financial concerns that arise when a person is diagnosed with cancer. This is a life-altering piece of news that you all receive, and it does have the potential to impact adversely on your financial position. People with cancer, we know, often face complex financial issues when battling their illness. And it's not surprising, really, given the average lifetime cost of cancer can be about 3.9 times the annual household income. Kate's introduced you. I'm Joan Berkery-Coleman, and tonight I'm presenting with Simon Lewis and Philip Morley. We're private wealth advisors with the financial planning firm Arrive Wealth Management, and together with the remainder of our team back in the office, are very proud to be associated with the Cancer Council Pro Bono, get this, program, and really delighted to be speaking with you this evening. This is, I said, my first, so please send in your constructive comments along the way just to help us improve our delivery to you. I've got to press the button for the slides, that's right. No? Sorry, the slide's not moving. Let's try the other button.
I'm just coming in to help, and it's distributed.
Oh, technology and I have teenage children, and I should have them here to help me along. Kate did tell me that earlier, and I apologise. It's me. Okay. Before we start, we have the disclaimer slide. This is a legal requirement. We all know about it, so let's face it up front. We've not had the pleasure of meeting with each of you individually. Therefore, tonight's presentation really is general in nature and does not constitute personal advice. But if the information does resonate with you and you have a general question, please send it through. We'll address it at the end of the webinar, and the webinar will go for about 30 minutes speaking, and then we'll come over to questions and answers. And if you need further personal advice, please contact your financial advisor or the Cancer Council to see if you qualify for their pro bono scheme. Okay. We say what now? People with cancer diagnosis and any other illness really worry about how they'll manage their finances. Often the cancer diagnosis means your financial goals and plans will change. You may need to manage your own money or the family's budget to incorporate the additional costs. We recognise that you'll experience additional financial worries associated with your medical expenses as well. So tonight we're going to have a preliminary approach to tackling the financial issues just by presenting some steps for you to cover. It's important in this journey that you seek some financial advice, even just from close family, friends, trusted advisors and professionals. There are also a number of specialist financial and support services available to you for help, such as Centrelink and the Cancer Council Pro Bono service. Don't take this journey alone, and we've developed a platform for you to start. So, the 5 steps to managing your finance. After your initial shock sets in, reality then hits. An orderly approach, though, to managing your finances makes the process easier. Determine how you're going to deal with your future change circumstances. Use these steps so that you stay in control, and they'll give you a structure to refer to over time so that you have a foundation to come back to. We'll now address each of the 5 steps one at a time. So the first, setting a budget. Collating your overall financial position is the very first step in regaining control. Knowing the funds you have coming in and matching your outgoings brings into focus your immediate position. Determine the time frame over which you will be facing these increased expenses. Record the amount expected and the time frame in which you will need to meet these. And look to see if there's an opportunity to alter some of your regular payments, such as car registration or mortgage payment dates, to better match your income cycle. Your other expenses then fall into ongoing living expenses and discretionary expenses. You'll hate this one, but keep a notebook with you for at least one income cycle, preferably 2. Record every time you spend money. You'll focus very quickly on those expenditures which are material and critical. Then look at your assets and liabilities. This will help you identify additional resources available and highlight areas where you may need to seek advice. If your budget reveals a shortfall, there is assistance for you. That assistance comes primarily or initially in the form of Centrelink. It's one of your first ports of call. Centrelink is an invaluable resource, but there are necessarily rules around qualification for Centrelink benefits and support. There's a raft of information available from the website, and a booklet can be obtained from Centrelink detailing payment summaries and waiting periods and all the rules. But Centrelink will support people in your various roles during your illness, not only as the patients, but also the carers, and then into the final stage, the bereaved carers. Generally, payments from Centrelink are subject to incomes and assets tests. The type of payment will depend on the status of the claimant, the levels of functionality, how disabled they are, whether they can work now and in the future, and what their prospects like of returning to work. Those born before the 1st of July 1955 are the only ones, though, who would be qualifying for the widow's allowance that's being phased out. In addition to your pension or an allowance, and even if you can only get a part pension or allowance, the pensioner concession card and the healthcare card can offer you substantial assistance with not only your medical expenses. These cards, the card holders may be entitled to rebates such as your energy rebate, your medical energy rebate, rebates if you've got to run a life support system, water rebates, and discounts from your local council, your utilities, car registration, public transport, and of course not forgetting the access to the concessional pharmaceutical products. However, prior to lodging your claim with Centrelink, there are one or two steps that you can take that will help you with the assessment. The other point, though, before we move on to those steps, is to advise you to go to Centrelink early in the stages and at least connect with them and find out what's there and what's not, so that you're not looking backward. They will help you work forward. With Centrelink, the assets and liabilities are looked at to have a look at your overall assets test. So you're tested for both assets and for your income. When you're looking to qualify for your sickness allowances and any of your allowances other than final retirement and in pension phase, your personal principal residence, so that's your home, and superannuation are both exempt from the assets test. So this is for your sickness allowance, for the carer's allowance. However, cash, shares and managed investments will be assessed. If the total value that you have of investments other than superannuation in your home is over the threshold, you'll not be eligible for the sickness allowance. However, if you, before you contact Centrelink, you think about making a concessional, a non-concessional after-tax contribution to your superannuation balance using your investment monies, then the assessable assets are reduced, and the level of deemed income from those assets is also reduced. Take care, though, if you are selling down investments, there may be capital gains tax implications. But going back to the assets test, you're also required to put a value on your personal assets, which is your home contents and your motor vehicle. The asset value to use there is really the fire sale value. What will I get for them if I sell them tomorrow, if I have to put them out and get money straight away? It's not the replacement value, it's not what you paid for them, and it's not what you insure them for or what you'd like to get for them. But a realistic fire sale value is acceptable for those assets. When you're also thinking about the Centrelink benefits, they're not available immediately, so there are waiting periods. there's an ordinary waiting period for allowances of 1 week. And if you have liquid assets, which include cash, shares, managed funds, there's a liquid assets waiting period on top of that. Now, Centrelink will have a look at your liquid assets and calculate them according to this little formula on the screen to determine how many weeks you can support yourself. And a maximum of 13 weeks is what Centrelink will delay your payment for. But there are practical ways to help you reduce your waiting period. Your liquid assets can be used to reduce debt. So if you make a lump sum payment, just a single lump sum payment, before you go to on your debt, before you go to see Centrelink, the value of your liquid assets reduces. If I, for example, had $10,000 in liquid assets and the $6,500 debt, if I didn't repay that debt, my liquid assets waiting period would take me out to 14 weeks, so I'd hit the maximum 13. If I paid down that debt, and I only then had $3,500 minus $3,000, I'm down to 1 week waiting period. So you can look to organise your finances. Centrelink payments will support your immediate living needs. They're not huge, but they're usually insufficient then to help you meet your loan obligations. And this is where we moved to our next step, which is managing your debts. Just excuse me, I'm keeping my pages so I know what I'm up to on my steps. Managing your debts. Your home loan. Assistance is available to ordinary home loan holders or home owners for times of trouble temporarily caused due to illness. You're not able to meet your payments. It's a personal purpose loan. It's not business or commercial. It's less than $500,000. But if you experience hardship in meeting those home loan commitments, Australian banks under Section 72 of the National Credit Code must treat clients in financial distress in a reasonable manner. Section 25.2 of the Code of Banking Practice also requires banks to work with clients in financial hardship. You can seek a moratorium on interest charges and repayments. See, banks only see account activity. Without your input, bankers won't know what's happening in your life. It's important that you tell your bank that your circumstances have changed and ask how they can help you. Each bank has an area dedicated to assisting clients facing financial duress. If you're uncertain about the process or uncomfortable undertaking the task, assistance is available to you. And assistance is available too for all your personal debts, not just for your home loans. So let's look at those other debts. And straight up, credit cards can be the bane of our existence, yeah? They are absolute saviours in times of illiquidity and helping us manage our monthly cash flow. But unless we keep on top of them, credit card debts have a way of creeping up. The interest rate on credit cards is high relative to other debt, and it's the compounding of this interest that will send balances outstanding even higher. So grab all your credit cards and review them. Prioritise them in order of the interest rate charged. Meet where you can all your minimum balance requirements, and then with any surplus, pay that off the highest interest rate card first. Once that loan is repaid, then move to the card with the next highest interest rate, and so on. The other thing to do is to think about consolidating your debts into a single loan and look to have the loan with the lowest interest rate. Banks often offer consolidation packages to take over all lenders and really good low interest rates, but just be really careful and seek advice to make sure that that offer is legitimate, because there are scams out there. A cheaper loan, simple admin, fewer fees, and only one party to deal with if you need assistance down the track are all benefits of consolidation. But if you get legal advice, don't delay. Seek advice. We've had great success this week, actually, with one of our clients being proactive with the bank and taking their problems to them. So getting advice and getting assistance is really important. Now, moving away from our debts and onto our assets. Another source of financial wealth is your superannuation. It used to be a little bit of a hidden store of wealth, but now there is so much media around superannuation, we tend to know where all it is these days. Still, it's something we put to the back of our minds until we're ready to retire or we reach our age where we're allowed to access the money. But think about where are all your other financial assets, smaller bank accounts that you might have forgotten, or thinking about if you had insurance policies and the company's demutualised, you may even have small shareholdings out there that you've forgotten about. The websites and the phone numbers on this screen are all very easy to access, and it's a very simple process to have a look and find out if there's anything there in your name. Do you know exactly how many super accounts you have, where they are and what they hold? And have you kept a record of all your personal insurances? Super is very valuable for you when ill health strikes. And there are two critical elements available for you: early access to funds and accessing insurance, which may be held inside of super, as well as in addition to those insurances that you have in your policies that you hold outside. All the little super accounts, if you have industry funds, they're quite important because a lot of these have default insurance policies, and it's worth your while having a look to see if you have anything hidden there. So accessing super. Super is set principally for our retirement, but there are rules within the superannuation legislation that will allow you to access some or all of your super monies on compassionate grounds or due to financial hardship or changed adverse health conditions before you reach your preservation age or your normal access age. So to qualify on compassionate grounds, you must contact the Department of Human Services and state your case. The DHS team will negotiate with you, seek relevant proof, and then make their determination. They will then issue you a letter where you take to your super fund, and the super fund will release the monies. So the first 4 points on this slide: medical, treatment, transport, home modifications, burial, palliative care, funeral costs, and mortgage assistance, all come under compassionate grounds. You must submit invoices and bills to prove your position. Severe financial hardship allows an amount between $1,000 and $10,000 to be released. To access this one, you must have been receiving a Centrelink payment for 26 weeks and then be approved by the Department of Human Services. After that time, it's automatic, really. What's called a Q230 super release letter will be provided upon your request. It doesn't happen automatically, as hardship is really proven by the fact that you've been reliant for that time on Centrelink benefits. You then take that to the super fund, and the super fund will allow for the early release. Permanent incapacity, coming down to the fifth point, allows for you to access both a lump sum and a pension. And permanent incapacity is you will never be able to work again, and is confirmed by 2 doctors. And then finally, terminal illness. Again, 2 medical certificates to confirm you have less than 12 months to live. And at that point, you can take all your money out of super. Again, care needs to be taken with each strategy, as this will impact individuals quite differently depending on your age. To ensure you choose the best and the most tax-effective option, seek advice. Now, not all financial help is within super. You also have the personal insurances. these have been taken up in the past for exactly the circumstances that you're experiencing now: ill health and incapacity, and maybe even death. Policies can be held inside and external to super. And a super account does not mean automatically that there will be insurance cover available. Many funds have at least a minimum default, but some don't have any at all. So you must actually approach your super fund if you're unsure. Income protection, it insures your salary if you're unable to work due to illness. There are rules around income protection and salary continuance cover, which usually require the individual to be working at the time of diagnosis or when you claim. Often a waiting period must pass before payments commence, so that might be 14, 30, 90 days. And where income protection is held inside super, it may only extend for 2 years and not out to the ages 60, 65 or 70, so you need to check that as well. Total and permanent disability, TPD as it is called, is your funding for permanent incapacity. Outside super, a TPD policy is paid out as a lump sum, but inside super you can take it as either a lump sum or as an income stream. And again, depending on your circumstances, may be taxed with a tax offset. Often you need to check your TPD cover, because if it is linked with death cover, accessing and claiming under a TPD cover may mean that the life cover or the death benefit is lost. So then the death benefit or the terminal illness cover is a lump sum payable on death, or may be payable on diagnosis of a terminal illness. And that's within 12 months where death is expected. In super, the death benefits can bolster the payments to your beneficiaries, or they can be withdrawn as terminal cover tax-free to help you meet your requirements now. A fourth cover is trauma insurance, which isn't held inside super at all. It provides a lump sum tax-free upon diagnosis and covers a number of cancer types of cancer. So it's worth having a look to see if you have a trauma cover as well. Super and insurance have great benefits, but again, there are rules. Some of the things to think about for your super and your insurance. Your superannuation and your insurance policies, they're not assessed by Centrelink until it's either released or your policy's claimed under. So where you can, consider preserving these to maintain your eligibility for Centrelink payments. If there is any chance that there may be some issues with bankruptcy or financial concerns for you, removing your benefits from super may make them available to creditors. It's an asset, superannuation is an asset that is generally protected from the laws of bankruptcy. So if you are eligible to withdraw monies, do so judiciously to protect and preserve the asset. And offset clauses usually arise with income protection. So if you're receiving an income from some other source, the income protection insurer will look at that source, at that income, and add it to the amount they pay. Subtract it from the amount they pay so that you don't receive any more than the net amount for which you've been insured. So there's no point having two income protection policies, because you don't get paid under both of them. You can't double up on that one. Okay, let's move on then and have a little bit look at the super death benefits and how they work. The sole purpose for super is to provide funding in our retirement, but where we don't make it to retirement, it is to provide our beneficiaries with financial support. And that's important to know that there's funds available for them. And it's even more important for you to ensure that they end up in the hands of those you intend. Some super funds also allow for an anti-detriment payment, which is just an additional payment that allows the beneficiary to recoup some of the taxes that have been paid in the past. Not all super funds, so again, you need to ask your super fund about that one. But looking then at death benefits, you are not in control of your super monies and they are not assets of your estate. So your super monies ordinarily don't pass through your will unless you organise it ahead of time. The trustee of the super fund has the discretion as to where the payment is directed. However, you can make a binding nomination that directs the trustee with respect to your payment. If that binding nomination is current, the trustee will abide by it. And most super funds require the binding nomination to be reset every 3 years. Payments are made to your beneficiaries. Now, there are two classes of beneficiary, one that receives tax concessions and one that does not. So your tax beneficiaries, those who receive the concessions, include your spouse, children under 18, or full-time students under age 25. Adult children, for example, are beneficiaries, but they receive no tax concessions on payment. They're not reliant on you anymore. Now, there are a range of nominations, as you can see, and each nomination has its purpose. If there are no eligible beneficiaries, the funds will be paid into your estate unless the trustee chooses another beneficiary. Furthermore, in the absence of a properly drafted will, there may be disputes as to who is entitled to your superannuation benefits in the estate. In a pension phase, a reversionary pension allows the pension payment to continue to be received by your spouse or your tax dependents. Clarity, speed of payment, and the ability to minimise any disputes can all be organised now by you through selection of the appropriate nomination that suits what you're wanting it to do. Where super is used for sole purpose and subject to the rules, it affords a most tax-effective structure. However, super withdrawals can have different tax consequences. It's important to seek advice as the same payment may have different consequences to differing beneficiaries. 60 is the magic age where pension payments are no longer accessible for tax purposes. If the deceased is over 60 with a super pension, the pension can then revert to a tax beneficiary as a tax-free payment, even if the beneficiary has not yet reached the age of 60. Where super is accessed under the age of 60, for non-terminal illness requirements, tax may be payable. Income protection payments are taxed at your marginal tax rate, just as an ordinary income. And TPD pension payments under 60 are subject to tax with a 15% rebate. TPD lump sum payments have a tax-free component and the balance is subject to tax. Your non-tax dependents can only receive a lump sum, and this is taxed between 15 and 30% plus the Medicare levy. So if you only have non-tax dependent beneficiaries, utilise the terminal illness strategy. Pull out your money tax-free and then allow the proceeds to pass via your estate through your bank account and your will. Where you have tax dependents, the death benefits can be met or can be paid as an income stream. The super income stream or pension is extremely tax effective. So your tax dependents are your spouse, children under 18, children under 25 if they're still full-time students, or you have someone with an interdependent relationship or is financially dependent upon you. And naturally, of course, disabled children stay in this class the whole way through, irrespective of their age. The super income stream allows the recipient to claim a tax rebate of 15%. So currently under the rules today, an income of around about $48,000 a year can be received under this income stream if it's the only source of income. If there's other sources of income in on top of this, then of course tax will apply ordinarily, but still with the 15% rebate for the tax on this stream. There are a number of strategies available to enhance the tax and the effectiveness within your family structures, so please seek advice before you do anything. And finally now, we've come to, when I click the button correctly, the last step, plan your estate. The next session in these series Kate's organised is estate planning specifically, but in the meantime, we believe it's imperative that you ensure all your assets work together. Your will is important. It's a valuable tool and can be used in conjunction with your superannuation. Where there are non-tax dependent beneficiaries, directing your super monies to your estate will at least save the Medicare levy of 1.5%. May as well save what we can. The trusted people in your life should also be aware of the status of your super monies. In the event a person relapses rapidly and has not had time to organise something like the terminal illness drawing, the power of attorney can do so on their behalf. And it's critical that your attorney and your medical attorney, if they're not the same person, knows and understands the importance of this aspect of your estate planning. Okay, this is the slide that says, look, she's nearly finished. What we've covered. Knowing what you have and what you're entitled to and staying in touch with those who can help you will make the journey through this new financial world just that little easier for you. Know what your budget is and take time to account for all items of expenditure and keep score in that booklet. You'll hate the booklet, but it helps concentrate your spending where you need it most. Access the help for which you qualify and help your qualification just with those few little steps we suggested. The team at the end of Centrelink are generally great and they do know what they're talking about. And Centrelink also has a specialist financial services team for additional assistance. Be proactive with your debt and make your bank aware of your position. The bank would prefer to manage and work with you than write off a bad debt at the end. And seek advice. Seek advice when accessing your insurances and your super particularly, as there are rules that must be followed and steps can be taken to improve the after-tax outcome for you. And finally, plan your estate to ensure the flow of funds are as you desire and in the most tax-effective way possible. For us, most importantly though, perhaps our biggest takeout for you is for you to recognise the value of seeking advice. The rules around super are such that it's critical to make sure your strategies work both within the rules and are efficient for you. And there really is no one size fits all. The Arrive team, Hillross Advisors, AMP Financial Planners, we're all volunteering our time and expertise to the Cancer Council Pro Bono program. Through this program, those who are unable to afford financial advice are matched with qualified Arrive and Hillross Advisors or AMP Financial Planners, and we donate our time and expertise at no cost. We consider it a privilege, actually. Financial planners can help you with a range of things, accessing Centrelink, looking at your accessing your superannuation benefits, making claims on your insurances, applying to consolidate debts and arrange terms, developing your budget and looking to managing your cash flow, and planning for the financial future for your family down the track too. Please don't hesitate to ask for our help.
Thank you so much, Joan, and I really do appreciate your time and expertise. And it's actually just making me realise how very little I know about my own financial situation, and perhaps I need to go and do some homework of my own. So, yeah, once again, I really do appreciate all the thought and time you've put in.